Money has a memory. Markets never truly forget. What feels new already happened. Wall Street learned this painfully. Long before modern investors existed, early markets looked simple, yet human behavior stayed identical. Greed, fear, hope, panic, the same emotional cocktail, changing costumes across decades. Imagine trading without screens, no apps, no notifications, just whispers, paper, and trust. Sounds safer, right, wrong. Early Wall Street was ruthless. Information traveled painfully slow. Rumors moved faster than facts. Banks loaned freely without restraint. Regulation was practically non-existent. Leverage felt like free money. People borrowed to buy stocks. Neighbors' tips became financial advice. Shoe shiners gave stock picks. Yes, that actually happened. Warning signs were completely ignored, because prices only moved upward. Does this sound familiar yet? Human brains love rising charts. Logic disappears during euphoria. By late 1920s, America believed in endless growth. New technologies fueled confidence. Radios, cars, factories everywhere. Prosperity felt guaranteed forever. Banks encouraged risky speculation. Margin trading exploded dangerously. Investors paid little upfront, borrowed the rest confidently. Profits felt easy and certain until confidence met reality suddenly. October 1929 arrived. Selling pressure appeared unexpectedly. Panic spread faster than fire. Prices collapsed within hours. Margin calls forced brutal selling. Liquidity vanished instantly overnight. Banks failed one after another. Savings evaporated without warning. Millions lost life savings. Unemployment surged to extremes. Breadlines replaced luxury lifestyles. Confidence turned into deep fear. Markets reflected collective despair. This crash reshaped financial history. Governments finally noticed responsibility. Regulation became a survival necessity. The SEC was eventually formed. Rules replaced blind market faith. Lesson 1 was painfully clear. Leverage magnifies both directions. Easy money creates fragile systems. When trust breaks, everything breaks, yet humans forget lessons quickly. Decades later, optimism returned again. New tools, new confidence emerged. History quietly prepared another test. And yes, it gets crazier because the market loves irony. If this shocked you, pause. Imagine experiencing it live, and we are just beginning. Time passed, lessons faded again, confidence slowly rebuilt itself. Technology entered trading floors, computers promised faster decisions. Speed felt like pure advantage, risk models looked extremely smart, numbers replaced human judgment, Wall Street felt unbeatable again, markets climbed throughout 80s. Profits became almost expected, portfolio insurance sounded genius, a safety net for crashes. Except everyone used same net. What could possibly go wrong? October 1987 arrived, a calm, ordinary Monday morning, until selling began quietly. Computers triggered automated exits. Selling caused more selling loops. Machines obeyed without hesitation. Humans watched helplessly stunned. The Dow collapsed 20% in a single terrifying day. Phones rang without answers. Liquidity disappeared yet again. Traders froze staring screens. Fear traveled at computer speed, faster than 1929. Markets worldwide followed instantly. Panic respected no borders. Governments stepped in aggressively. Central banks injected confidence. Markets stabilized surprisingly fast. Recovery shocked many observers, but scars remained deeply embedded. Lesson became very clear. Speed amplifies market emotions. Automation removes human hesitation. Risk systems fail together often. Diversification disappears during panic. Funny thing about protection plans, everyone trusts them simultaneously. Then protection becomes pressure. Sound familiar, modern investors? Because complexity hides real danger. Markets evolved, yet psychology stayed. Confidence returned during 90s boom. New products promised stability again. Housing finance looked boring safe. Banks believed risk was controlled. Spoiler alert, it was not. Another illusion quietly formed, setting stage for bigger collapse, and this one was personal because everyone owned a home and everyone trusted the system. History was warming up again. The new millennium felt unstoppable. Homes became guaranteed investments, banks packaged risk beautifully, complex products looked extremely safe, ratings agencies stamped approval easily, mortgages reached unqualified borrowers. Everyone believed prices only rise because housing never crashes right. Financial engineering hid real danger. Leverage returned wearing sophistication. Credit default swaps sounded protective, insurance without real insurance, banks bet against their clients, conflicts ignored during profit euphoria, then cracks appeared quietly first, defaults increased almost unnoticed. Trust between banks suddenly vanished, lending froze across entire system. September 2008 erupted, Lehman collapsed, shocking the world, markets plunged with historic speed. Retirement accounts bled relentlessly, fear returned stronger than ever, governments rushed massive bailouts, taxpayers became lenders of last resort, anger followed fear very quickly, millions lost homes, jobs, dignity. Markets reflected societal trauma, yet survival forced painful reforms, capital rules tightened significantly, stress tests became mandatory tools. Transparency increased across institutions. Lesson 3 became unavoidable. Risk never disappears, only moves. Complexity often hides old mistakes. When everyone feels safe, beware. Markets punish overconfidence brutally. History whispers before it screams. Smart investors actually listen. Fear creates opportunity for prepared. Excitement rewards disciplined patience. The market is a mirror, reflecting collective human behavior, not just numbers and charts. Understand psychology, understand markets. If this changed your thinking, like, share, and subscribe for more market history breakdowns, because the next crash is already quietly forming.